All right, everyone, welcome. Today, we're going to build the absolute bedrock of financial accounting. Now, I want to be clear, this isn't just about learning to crunch numbers. This is about understanding the logical system, the language that every single successful business uses to tell its financial story. If you want to be a leader, if you want to make strategic decisions, you have to master this. So, let's dive in.
So let's start with the big, fundamental question. Think about it. A company like Starbucks, they have millions of transactions a day. How in the world do they keep track of every single one, from a simple cup of coffee to a massive corporate purchase, and turn all of that noise into something useful? Without a system, it's just chaos, and you absolutely cannot make good decisions in a state of chaos.
Well, for hundreds of years, the answer has been this really elegant two-step process. It's beautiful in its simplicity. First, we record every single transaction the moment it happens. And second, we post that record into an organized system. That's it. This process, recording and then posting, is what takes that financial chaos and transforms it into real business intelligence. So let's break this down, starting with Act 1. The best way to think about this first step is to imagine the business is keeping a diary, a financial diary. This is the raw, unedited, moment-by-moment story of everything that happens financially in the company. Every single event gets its own entry. And in accounting, we call this financial diary the journal. Now, there are two phrases on this slide that are absolutely critical: book of original entry and chronological order. Original entry means this is the very first place a transaction is ever formally written down. And chronological order means it's sorted by date: January 1st, January 2nd, January 3rd. It's not trying to analyze anything, it's just capturing the story as it unfolds, day by day. This is so important because it creates what we call an audit trail, an unbreakable chain of events you can follow from start to finish.
Now, having a diary is fantastic for history, but let's be practical. If I asked you, how much cash does the company have right now, would you start reading the diary from page 1? Of course not. That would take forever and be incredibly inefficient. For making decisions, we need to take that raw story and organize it into something much more powerful. And that brings us to Act 2.
This organizer is called the ledger. The ledger is basically a collection of files, or what we call accounts. You'll have an account for cash, an account for sales, an account for rent expense, and so on. The process of taking an entry from the diary, the journal, and putting it into the correct file in the ledger is called posting. You see, the ledger doesn't care about the day-to-day story. Its job is to summarize. It tells you the total balance and all the activity for each specific category. Okay, this is a point where students often get a little tripped up, so let's really focus here. It's easy to confuse the journal and the ledger because they work together so closely, but their jobs are completely different. So let's put them side by side because getting this distinction down is absolutely crucial to understanding the whole accounting cycle. So here's the bottom line. The journal tells you when something happened. It gives you that chronological narrative. The ledger, on the other hand, tells you the impact on what account was affected. It gives you the summary. The journal provides all the detailed evidence, and the ledger presents the organized conclusions. One is the story, the other is the analysis of that story's key themes. You simply cannot have one without the other. All right, theory is great, but let's make this real. The best way to learn this is to see it in action. So we're going to trace a very simple, very common business transaction all the way through the system, from the moment it happens to the final insight it provides. And in doing so, we'll start to learn the language of accounting: debits and credits. Okay, so imagine your business makes a $500 sale, and the customer pays in cash. Step 1, we have to record this in our diary, the journal. Now, in accounting, for every transaction, the debits must equal the credits. We received cash. Cash is an asset, and the rule is that to increase an asset, you debit it. So we debit the cash account for $500. At the same time, we made a sale. That's revenue. And the rule to increase revenue is you credit it. So we credit the sales revenue account for $500. See? Debits equal credits. Perfect balance. Now for step 2, posting. We take that journal entry and update our files in the ledger. We go to the cash account in the ledger and add that $500 debit. Then we go to the sales revenue account in the ledger and add the $500 credit. One event, recorded in the journal, has now updated 2 separate summary accounts in the ledger. That is the essence of double-entry bookkeeping, and it's what keeps our whole financial system in balance. This whole process just perfectly captures that classic quote from the management guru Peter Drucker: "You can't manage what you don't measure." The journal, with its debits and credits, is how we precisely measure every single transaction.
But it's the ledger, with its organized summaries of all those measurements, that gives us the tools we need to actually manage the business.
Now, for you as future business leaders, this right here is the most important part of our conversation today. So what? Why do we go through all this trouble? Let's connect these mechanics back to the real world of strategy and making critical business decisions. What does the ledger truly empower you to do?
Think about these questions. These are the kinds of questions that CEOs and managers ask every single day, and you absolutely cannot answer them by reading the journal. If the CEO walks in your office and asks, "Do we have enough cash to make payroll this Friday?" They don't want a story. They need a number right now. You go straight to the ledger and look at the final balance in the cash account. Done. If a sales manager asks, "How much money do our customers still owe us?" You don't read through months of journal entries. You look at the balance in the accounts receivable ledger account. Simple. The ledger provides the specific, summarized, up-to-the-minute data points you need to make intelligent, high-stakes decisions.
And this right here is the core takeaway I want you to remember. The journal, our diary, gives us the raw data. It tells the complete story in all its detail. But it's the ledger that organizes that data, that transforms it from just a story into actual intelligence that we can use to steer the ship and drive decisions. They are two sides of the same coin, and one is useless without the other.
So, I'll leave you with this final thought. Think of your business like a basketball game. The journal is the play-by-play commentary. It describes every pass, every shot, every foul in perfect sequence. The ledger, well, the ledger is the scoreboard. It shows you the points, the fouls, the time left. Both are essential to understanding the game, but only one tells you at a single glance if you're winning. As you move forward in your careers, your success will depend on your ability to not only build, but more importantly, to read that scoreboard.